Chapter 1. What is accounting and how we're going to account, and what's the business environment that we have to deal with. The learning objective is why the accounting is important. What's accounting basically? Well, the accounting is looks like a special language which have specific terminology to fool the other people and make them think that we're doing something important. No, I'm joking. That's not what accounting is. Accounting is is it's a process of following up transactions from the time when the transaction happened, put it on the report, put it in the somewhere in some system that organizing all the transactions, pulling out from that system, put it on the report, and presenting reports to the users of the reports and explaining what's on the report. Then the bookkeeping is one simple element of the accounting. So the bookkeeper is the one who's gonna keep all the books in order, small to big order or big to small, depends on the bookstore. I'm joking. The bookkeeper will be the one who's record the transactions, and he does the only thing that he's doing. He keeping the book updated. Which book? Accounting books. Why? Because from those accounting books, we're going to extract that information. We're going to present it as a report to the users of the financial statements. So understanding what it all means and how the whole helps the better decision for the company, that's the purpose of the accounting. You to understand, to give you understanding of what's happening in the company, when it happened, what is the effect to the company, and what's the effect to you. So that information system that's going to measure the financial activities. We're going to process the information into the reports, and the accountant is the one who's going to communicate that information in order you to make the best decision. So that's what is called language of business. Accounting simply is one language of business. It was very interesting. I had a very interesting experience once. There was not that long ago where I live. There was this guy who's selling glass. He running this glass store with all the glasses. Everything is glasses with the cups and all those interesting things with the ornaments and everything, interesting figures in glass figures. He made a very interesting comment because I kind of going to his shop, so we kind of was on level high. And one day he asked me, "Hey, what are you doing?" I said, "I'm an accountant." So he said this, in my next life, before I start my business, I'm gonna study accounting first, and then I'm gonna open the business. Okay. So that was very interesting comment. So let's see why he's doing this. Now, in order you to understand what's happening in the business, we need to prepare the financial statements. Which financial statements going to be expressed in terms of money, dollars preferably. And that's going to help you to answer the fundamental business questions. Now on the reports, again, you're going to see only dollar amount. Even though you have 100 kilograms potato on your inventory, you're not going to put on the inventory in the financial reports 100 kilograms potato, 3,000 pounds of tomato, 3 watermelons, and 7 honey melons. We're not going to see that. We're going to see dollar amount. And because you see dollar amount, then we're going to start analyzing it. What we're going to start, which are the questions, which is the most common question that everybody asking? Am I making money? Well, technically speaking, making money is illegal in Canada, so we have to refrain from that activity, making money. Only Bank of Canada can make money. So for us, we have other options. What will be the options to earn the money? Now, in order to earn the money, we have to do some activities. Now, what will be the activity for the business? That will be different, depends on the business. We're going to come to this, what kind of activity the business have and what kind of type of businesses we have. And based on that, we're going to have some modeling of the accounting so we can extract that information to see if that business actually generates profit. The other question that these financial statements are going to give you, once you see that, okay, I'm generating profit, and at some point your profit start getting bigger and bigger and bigger, and then you're going to ask yourself, hey, should I hire more people? Or just to enjoy the big profit? And the next thing that you can see is, can we afford to purchase equipment? Do we have enough money to buy a new equipment? Now, one thing that you have to understand, if you have a household, you're buying TV to watch TV for your leisure time. When you're running the business, you're not buying TV to watch TV for your leisure. You're buying TV because you want to keep your customers entertained, which customers you want to retain in your business so they can give you more profit. So you have to understand the logic of buying new equipment and new machinery is not to entertain your business, is to generate more profit. So we are more rational when we're buying equipment and machinery for the purpose of the business. We just want to generate more profit. So what's the decision makers? Who's using the accounting information? The people who are making decisions. Decisions about what? Well, you may make a personal decision. So that will be individual. What the individual is going to make. Should they invest in this company? Is this company profitable enough? But then you might be seeing the whole picture from the investor's point of view. Business users. You may have internal business users. We may have external business users. Business users, when we say business users, that will be the managers of the company. What the managers want to see is, hey, is the whatever we sell in the line of this business, is it profitable or not? Is the line of this new chocolate is profitable or not? We're going to get it from extracted from the accounting information which we have in the accounting software. Then the two main users of the external financial statements are creditors and investors. Creditors simply wants to make sure that if I lend money to this company, would they have ability to generate me the interest, pay me the interest, and after that to pay me my principal. That's the only thing that I care. I don't care if they're healthy. I don't care if their business is profitable. I don't care if they're going to crash tomorrow or not going to crash. The only thing that I want to make sure is if I lend them $100,000, would they be able to pay me my interest and pay me back the $100,000? After they pay me $100,000 and the interest, if the next day they crash, not my problem. I already done my job. I get my money. Investors, the only thing that they care is, depends what kind of investors we have here. We're going to come to this based on the companies. We're going to have public company, private companies, but investors simply wants return on their investments. How are they going to get the return? Either through the dividend, and if it's the public company, increasing the market price of the shares. Then we're going to have those non-for-profit organizations, which we're going to, now, since it's non-for-profit, they don't care about the profit. But they want to see from the accounting information, they're going to extract information and say, hey, is the money that we're spending reaching enough people that we want to help? Government regulator and taxes, those are the ones who are passive users, but they need that information. Why? Because they just simply want to make sure how much taxes you pay, and the taxes that you're saying that you have to pay, is this actual the taxes that you have to pay? So those are the ones who's gonna need that information, but they're gonna doubt that information, or because obviously they want more from you. and there will be other, always other. So basically we can break it to the decision makers and anything else. Financial accounting. Now we're going to have, in accounting, we have two main type of accountings. First accounting is financial accounting. Financial accounting, what they're doing is, what we're doing in financial accounting is we recording the events during the life of the company, during the normal operation of the company. We put it on the reports, and those reports are used by external decision makers. Which are those external decision makers? That will be creditors, investors, and anyone else. Taxes, other organizations, everything that's interested in those regulators. Then we have a management accounting. Now, the management accounting also rely on the information that has been entered in the accounting system through the transactions for the day operations of the company, through the everything that happened in the company. But that information that we're going to prepare, reports that we prepare on the management accounting, it will be for the internal purpose only. We're not going to share those reports from the outside people, because based on those reports, we're going to make decisions about the future of the company. Do we want to continue to produce this product? Do we want to switch to new product? The current supplier of the materials that we're getting for our products, is it a good price? Is it reliable? Do we want to switch the suppliers? Those are the decisions that we're making inside. So internal decision makers may use both financial and management accounting. Why they're going to use that? Maybe because for some other purposes. But how are we going to separate it? Based on the users. So financial accounting. Should I invest in the business? Should I receive, am I receiving the enough return? Should I lend to this company? If I lend to this company, would they have the ability to pay me my interest? So one thing I want you to understand right here is, since we have two main users here, which is the investors and creditors, those are the main users, investors and creditors. We're going to come to those a little bit later. I want you to understand what's their motivation, what they're looking for, what's their objective. Investors, they're looking for return in terms of dividend, where the creditors, they're looking for interest, and interest only. They don't care about return. They don't care if the company is profitable or not. They want my interest. You may lose money, that's fine. Pay me my interest. Where the investors, they're looking for the return in terms of generating revenue. Now, management accounting, what we're doing, again, operational decision. Is this product line profitable? Shall we continue with this branch? Shall we replace this customer? Shall we replace this supplier? What exactly we're going to do? So basically, users will be inside the company, management, personal finances, anything like that. So for that reason, we're going to have this management accounting. The company lost money in the first consulting project. Management accounting information will be used to help the hunter determine what's the cost and what's the amount that we should charge for the consulting project. With the financial accounting, we're going to management bank manager will use the financial accounting information to decide whether should I lend the money to this company or should I not lend to this company. That's if we have the same information, how the user's looking for that information. Now, who are the people who are doing the accounting? In Canada, we have this accounting body, which is called Chartered Professional Accountants, which for the people who wants to continue with the accounting, I personally advise you have to get that CPA. And then you're going to have a very interesting life. Now, all the members certified under CPA designation are governed by the CPA Code of Professional Conduct. So basically, you cannot do whatever you want to do. You have to do the things that you have to do. As long as the things that you want to do are the things that you have to do, you are complying with the Code of Professional Conduct. But sometimes what you want to do is not what you have to do. And then you have to comply with the professional conduct. How that CPA was formed? That was formed more than 10 years ago now. Was 2015, 2014, the first merger happened, and then 2015 actually became January 1st. So it's a little bit more than 10 years. There are three formal bodies: charter accountants, charter management accountants, general management accountant, and certified general accountants. So from where I'm coming from certified general accountants. When we have more time, I'll tell you why. So now let's go with the Canadian professional. So auditors, those will be the example of the audit is example of the works that is done by the designated accountants. So all those designated accountants, do they have to do only accounting? No, you can do audit, you can do personal accounting, you can do management, you can do personal advisors, financial advisors, you can be controller, you can be CFO, you can be teacher, you can do whatever you want. Now, audit, what is the audit? Audit is examination, mostly examination, assessing the risks and responding to the risk. The auditor gonna express their opinion whether the financial statements are correct or incorrect, and they're gonna finish with the report. And that report is gonna say what exactly happened in the company. Now, the companies and the auditors and the relationship among the businesses entities, we're going to have decision makers, public companies, and independent accounting companies. So the Provincial Security Commission, so those are the relationship among the accountant and the business entities. So the accountants can work for the public companies, or for the decision makers, can be independent accounting company, or they can provide security commission, work for the security commissions. There are so many options for the accountants to work in the industries. This thing doesn't exist anymore. They get rid of it 3 years ago or 4 years ago. For the Canadian Professional Accounting Designation, is the only professional career that you have right now. There's nothing else. Ethics. Canadian accounting this relies on the ethics. Why are we focusing on the ethics? Ethics is something very important, which comes from the society and the behavior of the people in order not to harm the other people. So as you can see, is it ethical to hit somebody when he crossing the intersection? Probably it's not ethical. Is it against the law? That's questionable. What's the law is, right? And what's the effect on the society from that? That's a different aspect of the whole situation. So ethical standards, they may apply whether the public accountants or the private accountants are. So whatever accountant you are, you have to follow the ethical standards, which are accepted by the CPA. And the rules are focused on the confidentiality of the information, maintain the professional reputation, work with the integrity and due care and competence, refusal to be associated with any false and misleading information. You have to comply with the professional standards, and you have to keep independence. What means independence? Independence is very interesting because accountants who's gonna, let's say I'm a new accountant who's gonna start working on the company, which company, let's say service company, which provides education service. So I'm accountant in that company. And basically I'm start preparing the reports. What means to be independent? Come on, just a second. What means to be independent? Independent means that you don't know anything about the business and you're not planning to know anything about the business. You're not getting any personal relationship with the managers and everybody in the company in order to stay objective and in order to provide information which is independent. Is that possible? Obviously not. So to some extent, to be independent as a professional, it's kind of very, how can I say, very tricky to achieve. Come on, go for it.
So does rules change like rules focus on? So are rules also dependent on a number of factors so they can change?
The rules usually that's why they're rules, because they can change, yes, but they change in response to the reality. Usually when the rules are changing, when the public is affected and somebody is doing to harm the other people. When there's too much harm, then the rule regulators step up and changing the rules. The other time that the regulators changing the rules is when somebody with a lot of money is affected by the reality or because he wants to make more money. Then we're changing the rules as well. So you can see the changing of the rules is always happen after something else happened in the real life or after somebody wants more. For example, if the Canada revenue doesn't generate enough income from the individuals, what we're going to do? We're going to change the rules. How are we going to change the rules? We're going to put more taxes on the people. Are we going to ask them, do they like it? No. Why would we? We just want more money. The other time that we can change the rules is like a, let's go back to 2008 when the financial crisis came from the overstated price of the house market in US. Why that happened? Because the rule regulators producing false information provided to the investors, which information was false and incorrect. When that happened, when the financial crisis came, when there's so many companies was affected and so many individuals were affected, then the rule regulators step up and change the rules. Which rules they change? Mostly not to harm the public so much. You can harm them, but not so much, right? You still can harm people. That's okay. That's why the people are for. They're the one who pay, always usually paying the price. We're the one who paying the price. The big companies, they're not paying the price. So then we change the rules for the regulators. You cannot do this and this and this and this and this. Now on the same site, in the same situation where there's so many people lost money, they actually lost money. We change the regulations so those people not to lose those money again. Now, what on the other side, what happened is the big banks and big corporations also lost money from that on that time, but they went to the rule regulators and they changed the rules in their favor. So all the big banks with the big losses on 2008, if you go back 2008 and chase the big banks, which are affected by all the things that happen around the world, all the big banks on that year shows profit. None of banks shows loss. Even though they lost billions of dollars, none of them show loss. Why? Because they went to the regulators, they changed the rules in their favor, and boom, everything is fine. So Rules are good things, but it has to be used in the proper way and depends who you are. So ethics in the accounting, in the business, accounting holds a special position of trust in the society. Means that since we are professionals, the society tends to rely on our expertise. So the circumstances of or external pressure may influence the accountants, and there may be circumstances where the accountants are pressured by the other parties to do transactions which are misleading. And there might be a bias of the pressure to make the results to look better. So for that reason, the accountants have to be independent in order to avoid all those circumstances for the external pressure, all the circumstances from the pressure from the other people to present reports which are not reflect the actual reality in the company. Users must be confident that they rely on the financial information. That means accountants actually follow the rules. And if there's a breakdown in the ethical behavior, that's obviously is going to have a big impact on the public, which will be in form of the scandals, financial crisis, and anything like that. Then we're going to have those external auditors, which is going to come to the company and going to make sure that the accountant actually doing the right thing. The interesting part is all the financial crises. If you look back in the history, all the big financial crises, they didn't come from the accountants. They actually came from the auditors. But always accountants are the one to be blamed. So let's go compare and contrast the form of business. What kind of businesses we have? Now we have on the form of business, how we're going to make a business and how we're going to form the business. We have three types of business in here in North America. We have sole proprietorship, we have partnership and limited partnership, and we have a corporations. Why do we need to know those? Because different companies have different presentation of financial reports, and we're going to have a different information about their earnings. So let's start with this very brief chart on the who is the proprietorship and how we can form proprietorship. Proprietorship is the very easy form of business. One person, one business. Can you open business? Yes, you can. Do you need to go and do some formal opening? No. You can start business right now, right here, right at this moment. Then, what will be the life of organization? If you form the proprietorship by yourself, what will be the life? Life will be limited by your choice, or if you decide to departure from life. What will be the liability? You'll be personally responsible and liable for everything that you're doing under your name. What will be the legal status? Well, the business is not going to be separate legal entity from yourself. So you are the business and you are the individual. How is the taxation? Since you're the business, you'll be taxed on the money on the personal level. Proprietorship, there's no taxes on the proprietorship. Partnership. In order to form the partnership, you need at least two people. Can we have more? Absolutely. Can we here in the classroom create a partnership? Yes, we can. What will be the life of that partnership? That life will be the partnership will be until one of us decide to say, I'm out of this. Once one person out of, let's say with 33 people in the classroom, if one of us, we form partnership, if one of us decide, I'm done, then that partnership is dead. Then we have to form another partnership. So how we gonna be responsible? Well, we're gonna be personally responsible for everything. What means personal responsibility means that if some of us making something wrong, the creditors or the lenders can go after our personal belongings. They can go to your house and start selling your house, the TVs, washers, dryers, everything that they can find valuable so they can get their money back. What's the legal status on the partnership? The partnership itself is not a legal, don't have a legal status. The partnership is the partners. So the business is not legally separated from the individuals. Individuals are the one who holding the legal status. How are we going to tax those people? On the personal level. The partnership doesn't pay taxes. Individuals pay taxes. Same thing like a proprietorship. Proprietorship doesn't pay taxes. The individual pay taxes. Who is the individual? The owner of the partnership, of the proprietorship. Who is the individual in the partnership? The partners. Corporation can have one owner, can have many owners. It's not limited. But what's the life of the organization? Indefinite. Coca-Cola was created by original by one person, then moved to another person, to another person, to another person, to another person. Is the Coca-Cola still exist? Yes. Is the individual who created and opened the Coca-Cola in the first place still exist? I have no idea, but most likely no. But even if he exists and something happened to that person, is the Coca-Cola still going to exist? Yes. Now the shareholders are not personally liable, so the liability is only limited to their investment in the corporation. That's it. Is the corporate separate legal entity? Yes, it is. The individual has nothing to do with the corporation. The owner of the corporation is separate from the business. And who paid the taxes? Corporation paid taxes. I can see there's a comment. Let's see if this is the. What will be the maximum number of people in the partnership? There's no maximum number. You can put as many as you want. The thing is, would you enter if you personally are invited into the partnership with 100 partners? Would you enter in that partnership? Brian says yes. I would say no. Why? Too many people involved. What are the chances you to know the entire 100 people? What if you're the most wealthy of those 100 people and something happened and those people start taking money from the bank, and after that bank you end up paying all the other people's debt? Would you like that situation? No. So why are you going to enter in the partnership in the first place? Because you trust the person. There's a mutual trust. If there's no mutual trust, you're not going to go to the partnership. Now, in that case, which is the oldest partnership in the history of humanity? Do you know? This is a partnership in the history of humanity which exists from probably from day one. It's called marriage, people. Yes. It's not in the form of the business term, but it's a partnership. And how long that partnership lasts? At least one of the partners decide, I'm done. Or one of the partners decide to departure from life. And what's happened with the partnership? Gone. Right? So would you enter in the marriage with somebody that you don't trust? Questionable, right? So let's see. So let's start going now with the accounting, and let's once we know all these things, concepts, basic concepts, let's go with some other concepts on the accounting. Which are those concepts? How to improve? The whole question is, we have the financial information. The question is, how can we make it better? Obviously, I cannot paint something. If the company losing money, I cannot make it profitable. That's not the point. But what we're going to use to present that information and to make it reliable. So for different companies, we're going to use different set of standards. Uh, Generally, all the companies using the general accepting accounting principles, which are historically talking about has every country has its own general accepted accounting principles until International Financial Reporting Standard Board came, and now uh, do we have every country has to have his own rules? No, because as you can see, the world now is so open. So if you want to invest, you're not going to invest in Canada, you're going to invest everywhere in the world. The question is, would you invest in the company that you don't know anything about it? Obviously not. So what will be the thing that you're going to know about the company? Financial statements. So for that reason, we're going to apply the same standards to all the companies which are publicly listed. Which standards they're going to apply? They're going to apply international financial reporting standards. In that case, we're going to make sure that whatever statements we're looking, they have the same concepts, the same framework, and everything is the same. That's how we come up with the accounting concept. And the concept is established by International Financial Accounting Standard Board, and in Canada by the Accounting Standard Board. So we're going to make sure that every financial statements have the same framework of the financial reporting. Which are the objectives? All the financial statements have the same objective. Objective is of the financial reporting is to communicate useful information to the users. Second, the information to be relevant, to be comparable, to be reliable, and to be understandable. On the next level, we're going to chase all the information that we're presenting to our users have the same elements. They have assets, they have liability, they have equity. We're showing the revenue, we're showing the expenses, we're showing the gain, and we're showing the losses. And all the information that we're presenting to our users is going to have the same assumptions, it's going to follow the same principles, and we're going to be limited with the same constraints. So let's see now which one is what. Characteristic of the accounting information. Since we know the objective is to prepare useful information, second one's with what will be the characteristics. We're going to have these qualitative characteristics. Which are those qualitative? Relevant. What means relevant? To provide information which is useful for the investor decisions or creditor decisions. Reliable. What means reliable? In order to be useful, it has to be reliable. And the information is reliable when it is accurately represented and shows the actual impact of every single transactions. What happened in the company. And also there's no mistakes. Comparable. Comparable means that I can compare financial information of this business with the financial information with another business. Or I can compare this company every year. So when I look at the statements for 5 years for one company, the information presented is presented in the same pattern, the same way. So I can establish trends in the company and make my decision, should I invest in this company or should I not? And again, to compare that company to the other businesses in other industry, in the same industry. So now I cannot compare grocery store with the telecommunication company. That would be ridiculous. But if I can compare 2 grocery stores, because I expected that information to be in the matters which is comparable. Understandable. Understandable is very interesting because later on, for those of you who are going to continue with accounting, once you start looking for the conceptual framework, international financial reporting standards, you're going to find something very interesting. But in order to be understandable, information has to be clear and has to be concise. That's once you made the definition of clear and concise, in that case, it can be understood or not misunderstood. Now, but if the users of the financial information doesn't have ability to read that information, that's not our problem. If the person doesn't have no idea about the accounting, so let's say you right now, you want to invest, but you have no idea about the accounting. You have no idea what the asset is, what the liability is, what the equity is, from where the revenue comes from, where the expenses going, how to calculate the profit, and you want to invest your money, and you end up losing the money. Can I blame the accountant that I don't understand accounting? No, you can't. The fact that you have no understanding about the accounting information, it doesn't mean that the information is not understandable. Now, consideration. Consideration will be about the economic entity consideration. So each entity is accounted for separately and distinctly from the other organizations. For example, sole proprietorship must ensure that the accounting for the business transaction keeps separate from the personal transaction. So you're doing let's say your proprietorship. You open your proprietorship and you decide to do plumbing business. But your wife went to buy the grocery. Is the grocery part of the plumbing business? Well, let's think about it. What kind of expense will be that for the plumbing business? Is it going to be for the water? Is it going to be for the supplies of the plumbing? What exactly is going to be? It doesn't fit any of those categories. So let's keep it separate. If I want to get the business and how this business operation goes, I'm not going to mix this one. First, you don't want to mix the reporting because you may start running profitable plumbing business, but because you're matching the different expenses which are not related to the business, that's going to affect the profit and going to show you the results which are not there. Second will be the group of related corporations must ensure that the account for business transactions accurately for each legal entity. So basically, if let's say we are rich enough and we open 5 businesses, one dealing with the construction, the other dealing with the businesses, the other dealing with the manufacturing. So the expenses for the service company, we're not going to account it for the construction business. And the same, the expenses for construction business, we're not going to account it for the manufacturing business. We're going to keep it separate. Why? Because we want to see the real picture of the business. Also, company may keep each department accounting separate. So basically, if you have a different divisions of your company, then you're keeping those accounting separate. If you have a company which have a office in Manila, office in London, office in Singapore, you have different accountants in each of the office. So you want to keep track of that particular office, how much they money make and generate on that profit, that office. Going concern assumption is one thing that's basically we assume once we're preparing the financial reports, we assume that the company is going to keep going for the foreseeable future. I mean, it's not going to stop business tomorrow. So that means going concern assumption. So basically, the companies keep going to existing on foreseeable future. This allows the users to use the resources rather than be forced to accept whatever price we can get for the bankruptcy. So what that means, you can easily see it, and you can see it in the personal life. What will be the example in the personal life will be very simple. Let's imagine, I'll share you my example, and you see the application for this. At the time when they decide to move on from my country and came to Canada, now that going concern assumption doesn't exist anymore. Why? Because I know my departure date. My departure date was May 25th, 2003. So very soon I'm going to have university, 22 years in Canada. So for that reason, I have to sell all my assets to convert them to cash and to move to Canada. I had to sell my car, right? Now, if I haven't left Canada, I haven't left my country for origin coming to Canada, I would put the car on the normal market price for that particular car, and I'm gonna wait patiently until the actual buyer comes and I get the price that I want to get. That will be the normal operation, which there's no going concern assumption. But because now I have this going concern, because I'm leaving, I know the date. Now I'm pressured by the fact that I'm closing business. So I have to take any price, whatever is acceptable, just to move on. And that's what I did. I took a hit on the my selling price on the car. Why? Because I want the cash right away. So you're selling it under different circumstances now. All the assumptions have changed. The same example will be here. So this allowed the resources to be rather being forced to accept whatever price is this. If the entity is not going concern, then the accounting is done under the bankruptcy consumption. So basically, if we don't have a going concern, if a going concern is there, so basically I'm still going to be there, I'm still going to live my life, then I'm not going to be forced to accept any prices. But if I'm under the not in going concern, that means I have to take whatever I can, and then will be different conditions. I have to apply different accounting rules and sets. The other thing that we assuming when we preparing financial statements, that we assuming that the monitor we have working under the stable monetary assumption. That means level of inflation is not high enough to affect the financial statements. For that reason, we ignoring that effect of the inflation. Obviously, if we have experienced hyperinflation or significant deflation, either way, we have to use some special treatments for the accounting. It was very interesting. I'm not sure if you have that experience ever. I don't, I hope you're never going to have that experience in your life because it's the horrible experience. But I have this experience of living under hyperinflation. And that was 1996, 1997. And so in 1997, I started my first accounting job. Was March, I believe it was March 24th. March 24th, 1997, I started my first accounting job. And they hired me at $14,000. No, 14,000 their currency on that time, which was very good salary. 14,000 per month. That was March 24th. On March 31st, my salary became 28,000. On April 15, my salary became 56,000. On April 30th, same year, we're talking about 15 days later, my salary already happened 102,000 local currency. The reality was, with the 14,000 that I started, I was able to buy more things that 1 month and 10 days later with 102,000 of the same currency. So what happened is You wake up in the morning, you're going to the store, and you see the loaf of bread costs $10. By the afternoon, the loaf of bread is $50, 50 bucks. Next morning, the bread starts with $100, 100 currency. By the end of the day, you already hit 200. And that continue for like 3 months. And after that, we went under the monetary board, financial board, and then they catch the inflation. So I'm not sure if you had that experience, but that's a little very horrible. Very horrible experience. Uh, I don't wish any of you to have any of those, especially when you're young. So what's the other one is the cost principal measures. Is with cost principal measures is also known as original or historical cost. That means the acquired asset and services should be recorded at their actual cost, which is the original cost. And cost benefit, you always have to think about cost benefit. What's the value of somebody to make my accounting when he charging me $100,000 when I'm running grocery store with annual revenue of $50,000, right? Always have to think about it. What's the value of the information prepared versus the cost to prepare that information? The other thing that we have to do is, that's the first thing, cost versus what we get, benefits, cost benefits analysis. And the other one is the materiality. Materiality is something very interesting. Materiality is the amount that's going to change your behavior. For example, imagine this. Imagine we're in the classroom, and from the classroom, you're going home. By the time you go home, when you go home, you're checking your pockets and you find out that you lost $2. Are you going to sleep tonight? Most likely you're going to sleep, correct? Now the question is, what will be the amount that you're going to lose, which is going to change your behavior? So let's test. Imagine the same thing. You're going from the classroom to going home. Once you go home, you find out that you lost $1,000. Are you going to sleep tonight? If the answer is no, that means $1,000 is material. $2 is not material. So how are you going to come up with the materiality? Start reducing the $1,000 and come to the point of what will be the amount that you can lose, but you're going to still sleeping at night. Same thing with the investors. Investors going to look, well, what is the amount that if I know that there's a mistake for that amount, but I'm still going to invest in that company. That's called materiality. Let's go now with the next part. Now we're going a little bit more interesting. I know I'm kind of pushing right now. Do you want me to give you a break? Okay, let's go then. How is the lecture so far? Is it interesting? Okay, let's go in now with the accounting equation. And how are we going to do this accounting? Obviously, we're going to have these business activities. One thing that I want you to understand, and I want you to kind of process it. We want to generate profit, correct? Everybody, that's why the people open their business. They want to generate profit. The question is, what's the activity that's going to generate us profit? let's think about for a second. Let's imagine we're a merchandising company. So basically, we're buying and buying and selling, nothing else. Let's pretend we're buying laptops and we're selling laptops. We're in the business of selling laptops, which is the activity that's going to generate me profit, selling. Now I have to sell the laptop, correct? But can I sell the laptop if I don't have the laptop? How? The person coming to my store and saying, what are you selling?
Can
Laptop.
you, sorry, sell it on like pre-order so you get the money?
No, no, we're in the store. We're in the
Oh,
store, right? We're sitting in the store. And we're selling laptops. We're putting big label, we're selling laptops. The customer comes, there's nothing in the store. Can we selling the laptop? No, right? So now, yes, back in the Middle East, back in the days, a long time ago, if you're watching the movies and you're watching carefully the movies, you're gonna notice that in every store, in every place that they're selling something, there always one small kid sitting on the step before you're going to the store, and then anywhere closer to that store. The question is why? Now, that kid has a purpose. He's not a random individual sitting there. So what's happened long time ago, right? When the person go to the Middle East in the store, and he just walking in the store, and usually the one who's selling the goods in the store is the owner of the store, right? He's not his employee. He's not like he's actually the owner. So the customer comes, he look around and he tried to leave, and then the owner says, "Oh, hold on a second. What's happening? What's going on with you? Let's have a tea." Okay, let's have a tea. It's on the house. So you're sitting on the house. So tell me, what are you looking for? I'm looking for this and this. Oh, okay. What color? That color. But you don't have it. But don't worry about this. Let's have a tea now. Tell me what you're looking for. He's saying, I'm looking for this and this and this and this. By the time he find out what the customer looking for, then he's whistling the kid coming, go to that place, tell that guy to give you this and this and this and bring it right away. By the time they finish with the tea, the kids is already there. The item is right in the store, and he's selling it. The customer is happy. Now, on that case, yes, you can sell something that you don't have, but you still have to purchase it, right? But the whole idea is, can you sell something technically before you have it? Technically, you can, but you still have to have it. So which one comes first? The point is you to realize which comes first, cost or sell. So do you understand that? So now, in order to have the cost, now the question is, so I need to have it first before I sell it. But the revenue comes from the difference between sales and the cost, correct? As long as you're selling more than the cost, you're generating revenue. On the any other cases, you're going to lose money. No questions about it. Now, the question is, that means I have to purchase the laptop before I sell it. How can I purchase the laptop? I need to have cash, correct? But I just opened the business. So imagine this. Today we decide to open business. Okay, we open in the business. We're gonna open the corporation because I don't want to the whatever people are happen with the company to go to selling my TV. So I open the corporation, which is separate legal entity. I'm starting my business. I want to generate revenue by buying and selling laptops. But there's nothing in the company. So what do we have to do? First is to have a loan. Okay, I'm going to the bank, and banks ask me, Okay, can you show me what the company has? Well, I just opened it. Well, do you have any assets in the company? No. Is the bank gonna lend you money?
No.
No. So how are we gonna get the cash to get the computers, laptops? Which laptops gonna sell? Which gonna generate in cash? From where we gonna get the original cash to buy the laptops so we can sell the laptops and we can generate the profit? Startup money like yourself. So what do we need? So we don't need creditors. What do we need? We need investor. So the investor will be the one who's gonna go after the profit. Remember, the creditor, he doesn't care about the profit. He cares about the interest and principal. So we need to have investor. So when we are small business, who will be the investor? Yourself. Now, let's think about something else. We are living in a city that development of the houses, it's kind of still booming, right? Now, let's pretend that we want to build a three stories, uh, three stories condo building with 150 units. What are we gonna do first? Are we gonna start construction right away?
No, we will find investors first.
We're gonna find the investors, or we're gonna start pre-sale. Make sense? When we start getting enough cash, then we're gonna start our operation. So all the business is like this. So first, what we need to generate assets. What is the asset that we need to start the laptop business? We need cash. Once I have cash, then I have convert the cash into laptop, which laptop is going to become an inventory, which inventory I'm going to sell. I'm going to generate cash. And I'm going to start again. Cash is going to convert it to inventory. Inventory, I'm going to sell it. And then I'm going to generate more cash. And keep going and keep going, keep going. Like a Rockefeller a long time ago. Remember how the Rockefeller, when they asked him, hey, how you become rich? He said, well, I had $1. I bought one apple. I shine it. I sell it for $2. With $2, I bought two apples. I shine it. I sell it for $4. With $4, I bought four apples. I shine it. I sell it for $8. And then the interviewer asked him, "Is that how you become rich?" He said, "No, no, no, no. 1 week after my uncle died and left me $10 million." So the question is, can you become rich by shining the apples? But definitely what we need first, we need assets. We need this economic resource. From where we're going to get the economic resource? Either we're going to invest, either we're going to borrow it. But without assets, nothing's going to happen. It doesn't matter how great idea you have to run the business, the laptop business. If you don't have a cash, you cannot buy a laptop. If you don't have a laptop, you cannot sell the laptop. Even if you, let's say you sell it first, but yeah, that might work actually. If you sell it first, then with the money that you're getting, you can then buy the laptop, but you have to generate a ginormous profit so you can do this transaction again. So anyway, you need that somebody to get the economic resources. So the economic resources is called your assets. Now the question is, from where the assets come from? Well, they're gonna come from the investors or gonna come with the creditors. When we're borrowing, that will be a liability. When we invest, that will be called equity. And then we're going to the accounting equation, which accounting equation is very simple. Assets, it's always equal to liability plus owner's equity. If you invest something, that's your equity. With the assets that you invested, which become your equity, now you can start your business. So the owners, so the economic resources that you're having in your company, they belong to whom? Either to you, either to the outsiders. Make sense? So if you, let's imagine now, we open our business. We start opening our business right now. We start buying and selling laptops. We need $2,000 to buy at least 2 laptops. From where are we going to get it? We're going to invest it. So now, for my personal account, the $2,000 go to my company account. Make sense? Are those my money now? No. They're now company money. But the company owe me $2,000. Make sense? So now you yourself, you open your business. You're investing in your business. Again, we open corporation. Once you invest $2,000, are those your money? Not anymore. Now they belong to the company. What the company is going to do with those money, that's a different story. Are you the owner of the company? That's again is a different story. But in that case, the company owns the money to the owner, which happened to be you. Now, the company with those $2,000 that they have in the company account, the company can buy assets, laptops, sell the assets, company can generate revenue. And if the company generates revenue, that revenue is going to belong to you. And company is going to owe you money. Make sense? So the economic resources that the company is going to have is going to be equal to the portion of the owner's equity plus the portion of what the company owns to the outsiders. And since we're the only one who generating the assets in the company only owns money to us. So let's see what the asset is. Asset is economic resource, which is controlled by the entity. And those are the expected to benefits in the future. We have those economic resources which are controlled by the entity, and we expect to generate benefits in the future. Example will be cash, accounts receivables, not receivables, prepaid expenses, land and building, equipment, furniture, fixtures. Right now, I'm just going to mention it. Later on, we're going to explain more what is that, each of those. Liabilities. What is the liability? Liability is the amount that the entity owes to third parties, which are often called creditors. Example will be accounts payable, not payable, unearned revenue, or bank loan. Now, once we look at this equation here, now we have this equation here. I'm going to use this slide right here. Let me see if I can, this one let me go. Yes, it let me go. And once we have this equation, in our accounting equation, don't forget this asset is equal to liability plus equity. Once we know that one, now we know what the asset is. We know what the liability is. From this formula here, can I express equity only? Well, obviously, equity is going to be equal to assets minus liability. What that means to us? That means with the resources that we have, once we pay the liability, which we own to the third parties, if there's anything else left, that belongs to the owner of the company. So the equity simply is what's left from the assets after we pay the liabilities. Is that actually true? Let's think about it. Is that actually true? Do something for me. Think about this way. Do you know how much money you have in your bank account right now? Is there anyone that doesn't know how much money he has in his bank account right now? Probably all of you approximately know how much you have in your bank account, correct? That's your asset, correct? It's a financial resource, economic resource, which is controlled by you for generating the future benefits, correct? It meets the definition of the assets. Cash that you have in your bank account is your asset. Now the question is your asset equal to your equity?
No,
Why not?
because for example, if we have some like bills to pay or like rent, gas, anything, we need to pay from that money,
Thank you.
right?
Thank you. So what's your equity? Whatever you have in your bank account minus everything that you have to pay.
Yes.
Once you clear your liability, then you can clearly say, these are my money. Correct? Same thing with the idea with the accounting. You always have to consider. So what will be the owner's equity here? Owner's equity will simply present the amount that is owned to the owners. How much will be that? That will be often referred to as the net assets. What mean net assets? Means assets minus liability. That's your net asset. Isn't that true in your personal account? Absolutely. Net assets is whatever you have minus the outstanding liability that you have right now. If anything left, that is owned to you. Also is called, so that's combination between, so owner's equity, we can make it like this. Capital, which is the money that you put in your bank account, plus revenue, that will be the income that you're generating from your payroll, if you're working, minus the expenses that you pay from your bank account, and minus the withdrawal that you're doing from ATM. Once we add the beginning balance, whatever you put in your bank account, plus the income that you generate, revenue that you're generating, minus the expenses, and minus the withdrawal, is going to give you how much is your amount that you have. So, owner's equity, again, on the sole proprietorship, will be owner's equity. In the partnership will be partner's equity. If the corporation is going to be shareholders' equity. What the owners can take. Imagine this. You open proprietorship. You're plumber company. You know the business generating money. Do you want those money? Of course. How can you take it? Withdraw them. So every time when you're taking the money from the business, in the sole proprietorship is going to will be withdrawal. Once you withdraw, that will reduce your equity in the plumbing business. Now let's see the partnership. The partnership with your partners, the partnership generating revenue. The partners, they want something. So what they can do, they can withdraw from the partnership. They withdraw from the partnership, so the money that revenue in the partnership getting less. Why? Because they're withdrawing from there. So their equity in the partnerships getting less. How about the corporation? Can you withdraw from the corporation? Answer is no. So how can I get the money from the corporation? Well, the corporation have to give you the money. How? Dividend. Is there any other way you can get money from the corporation? No. The only way to get money out of the corporation is dividend. So, what we're going to do? Owner's equity. Let's think about the owner's equity. What's going to increase my owner's equity? If you put more money in your bank account. From where? If you invest more in your bank account, that's going to increase your owner's equity. What else increasing the revenue? Or employment income in your bank account. When the company generates revenue, owner's equity goes up. If the owners invest more money in the business, owner's equity goes up. What's going to decrease the owner's equity? Well, obviously, if the business pay expenses. Every time when we have expense, the owner's equity is going to go down. The other thing is, every time when the owners take money from the business, the owner's equity is going to go down. Now let's see what's the revenue. Well, the revenue is amount that is earned by the business for delivering either goods or services to the customers. So from where the revenue comes from? From the customers. Now, you may ask yourself, well, in my personal account, from where the revenue comes from? From your customer. If you're working, it comes from your customer. Who is your customer? Your employer. Why? Because you're providing services to your employer, and your employer pay for those services in form of cash. Now, example will be fee earned, sales and merchandising, rent earned, interest earned, anything like employment income earned from selling the services to your customer, which is happen to be employer. Expenses. What's the expenses? That's the amount that either we have been paid or either we have to pay for the cost that's related to earning revenue. Now, it's very important you to understand that expenses is directly related to earning revenue. Make sense? So what drives the revenue? Service or goods that we're selling. So as long as the expenses are related to the service and the goods that we're selling to earn the revenue, that's considered expense. So example will be rent, salaries, utilities, supplies, amortization. And then we're going to have this expanded accounting equation, which will be, again, asset is going to be equal to the liability plus owner equity. But now we know what increasing and decreasing the owner equity. Owner equity is going to go up when the owner invests more assets in the company in terms of cash. The owner's equity is going to go down when the owners withdraw money, but owner's equity is going to increase as long as company generating the operation generating income. And it's going to decrease if the operation generating loss. From where the income is going to come? Revenue minus expenses. Make sense? So as long as revenue is more than expenses, that's good for the owner. Why? Because owner's equity goes up. Now he can take more money from the company. Liquidation and owner's equity are the same or not. Now, depends what you mean by liquidation. Elaborate a little bit more, please. I want to understand what meanings you put on liquidation, and then I can explain. So let's see now what's accounting for business. Accounting for business transactions is critical point. So why? Because we're gonna record the relevant business transaction into the proper accounts, from which accounts we're gonna prepare this simple equation: asset plus equal to liability plus equity. So that accounting for business transactions, we're gonna define the appropriate account, which probably is gonna belong either to assets, either to liability, either to equity, and we have to make sure that everything is perfectly balanced. So let's start with something very, very, very simple. Now, before we start with something very, very, very simple, I want to get you involved in this whole process. So what we're gonna do is a very, very, very simple thing. Let me find something first, and then we can move with that one. Just give me a second, just for a second. Before we're doing this thing, the whole thing, I want you to do me a favor. I'll show you where is it, and I want you to go there and pick it up. I want you to go to Blackboard as we speak. Let me find it first. Let me share my screen. Go to Blackboard. Can you see my screen? So I want you to go to the course content. I want you to go under chapter 1. I want you to scroll down and go to the point that says cases for practice. And you're gonna open something like this. And I want you to open this document that says Q5 transactions. Can you guys see it?
Yes.
Open it, please. It's gonna probably, and so once it opens, download it from here. Download it on your computer. Once it downloads on your computer, save it on your computer, and let's open that document together. As you can see, I'm opening exactly the same thing that you're doing. So now I'm going to stop sharing this screen, and I'm going to open the Excel spreadsheet that I just opened. And you tell me if you guys see the same. Can you see the same?
Yes.
Everybody can see it, right? Yes, you can answer it later. Yes, it's available for you. You can answer it later. Just use the recording, and in the beginning work with the recording to see what exactly we're doing. But yes, definitely you can do this later. So now, those are the transactions. Now, as you can see, we're following the basic accounting equation, which means asset is equal to liability plus shareholders' equity. Under each of those, under the assets, we have assets, which are cash, accounts receivables, equipment. Under the liability, we have only one liability, accounts payable. And under the stakeholders' equity, we have common stocks or common shares, revenue, expenses, dividend. The whole point is when we're doing the transactions, we have to place it somewhere, but we have to keep the accounting equation in balance. That means if we put cash, that means on the other side of the equation, we have to have something that balances it to 0. And here on the last column here, we're going to be check. If on one side we have more than the other side, there's a number here. The objective is to keep this check 0. Make sense? So let's start with this and see what we're going to get. First, let's start with the first transaction. Stockholders invested 36,800 in the business dollars. He's invested $36,800 in the business in exchange of the common stocks in the company. Now, if somebody invests $36,800 in the company, what the company get?
Cash.
Cash. So let's increase the cash. So suddenly the company has cash, 36,800. Make sense? Why the company have cash? Because somebody invested. What he get for his investment? He get common stocks. Make sense? So what we have to do? We have to increase the common stocks with the same amount. Remember, we have to keep the equation in balance. Question is, are we in balance?
Yes.
Yes, we are in balance. So let's go with the second one. So we did our job on the first transaction. Let's do the second one. Now, the company purchased computer for office use, which we're going to record as equipment, for $27,600 on account. So now, let me elaborate a little bit on the term on account. What means the term on account?
Is it expense?
Sorry?
Expense?
Just a second. I want you to explain a little bit and then you're going to get it. Have you been anywhere in here in Vancouver in a restaurant? Right. Yes, right? So the question is, let's pretend that we're going to a restaurant that's also you can order some drinks. So the waiter comes to take your order. And you also want to order some drinks. What the waiter is going to ask you? Should I put it on your top? Correct? What means top? Top means, can I open an account for you? What that means to open an account for you? That means you don't have to pay right away. When you have to pay? When you close the account. When will be that? When you finish everything that you're eating and everything that you're drinking. So can I purchase something on account? Yes, you can. Do I have to pay right now? Don't worry, it's on your account. When you're gonna pay? When you're ready to pay, close your account. Make sense? So the question is, when I purchase something on account, do I have to pay cash right now?
No.
Do I have to pay cash later?
Yes.
Yes. So what is that for me? Is that liability for me?
Yes.
Yes. Why? Because now I'm liable for something that I purchased, which I haven't paid, but I have to pay later. Make sense? So every time when you see on account, that means when you purchase, that means we're creating a liability. Make sense? Now, the opposite is equal to the sales. When I'm selling something, but the client doesn't pay me cash, I'm opening account for the client, which account later client has to pay. Now, when I'm purchasing, that will be related to accounts payable. When I'm selling, that will be related to accounts receivables. Make sense?
Wait, can you say that again?
Yes. So, can I purchase something without paying cash right away?
Yes.
Yes. Do I have to pay cash later?
Yes.
Yes. That means by the time when the moment that I'm buying it, I'm not paying it, but I have to pay it later, correct? So that creates a liability for me. Make sense?
Yes.
So now let's go on the other side. Let's start selling. Now I'm selling something, but the client says, can I buy it on account? You want to do the sales, right?
Yes.
So, but he's not paying you right away. Do you have
Yes.
to receive money later?
Yes.
Yes. Is he going to pay you later? That's a different question, but let's assume that he's going to pay you later. So that creates accounts receivable for you. Make sense?
Yeah.
Every time when you're selling, the client don't pay you, accounts receivables. Every time when you're buying, but you're not paying, that's accounts payable. So let's use this. Let's use this logic. And now we're purchasing equipment. What we get? What the company get? Company get equipment, right? What's the cost of the equipment? That will be 27,600. Now, did we pay cash? No.
No.
Do we have to pay cash?
Yes.
Yes. So that will be liability for us. So I have assets. On the other side, I have liability. Is my asset equal to my liability plus owner's equity?
Yes.
Yes. Am I in balance?
Yes.
Yes. Let's go with the next one. Now we're paying cash for rent, the storage space. Now, what kind of business we're doing? We're doing computer service business. The question is, can I do my business without having storage space?
No.
No. So this rent, is it for my personal use or for the use of the business?
Business.
Business. Why I open my business? To generate revenue, correct?
Yeah.
But is this expense related to generating of revenue?
No.
What do you mean?
Wait.
Right? If I don't have the office space, the storage space, can I generate revenue later? No, right? I need that storage space. So that payment that I'm making for cash is related to my revenue, for my operation. So what will be that for me? That will be expense for me. Make sense?
Yes.
Okay, so let's go now. Did we get cash or we pay cash?
Pay.
Pay cash. So we'll be plus or minus cash?
Minus.
Minus. Let's go with minus cash. Minus $3,680. Now let's see what we're gonna go on the other side. Now the expenses, are they gonna increase the equity or gonna reduce the equity?
Reduce.
Reduce. So that will be the same thing, minus $3,680. Are we in balance?
Yes.
No.
Yes. Minus cash 3,680 minus expenses, which are reducing my equity. I'm in balance. Let's see the next one. Now we performing and we delivering computer service to our clients for 70,418 on account. So once we perform the service to our clients, what will be that for us?
Is the account
Revenue.
receivable?
The revenue. Yes, it's going to be accounts receivable because they're not paying, but first I was chasing to see the revenue, right? Yes, you're right. Both of you are right. So first, let's get the revenue. Now finally we're generating some revenue here, 70,840. But because the client doesn't pay me and he's going to pay me later, that's going to create for the time being for me $70,480 accounts receivable. Make sense? The question is, are we in balance?
Yes.
Yeah.
Yes. Now let's go with the next one. Number 5. What's happened with number 5? Now the same thing. We perform computer services for this company, but this company actually pay us cash. So what do we deliver to the company?
Cash.
Now the company give us cash, but what we perform for the company, we
Revenue.
perform revenue, right?
Revenue.
So let's get the cash. You're right. Once you see the cash, always first thing objective, get the cash. Right? Make sure that you get the cash. Once you get the cash, let's now chasing the revenue. Revenue is gonna go up. $4,600. Make sense?
Yes.
Now number 6, what's happened number 6? We paid for this company for energy use in May. The energy that we're using, why are we using that energy? Because we open
To-
our business, right?
To make a revenue.
Right. So what will be that for us?
Expense.
Business expense. And how we have to pay? Cash.
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 So let's reduce our cash with 7,360. Let's put the same formatting. And what's going to happen? Our expense is going to go up and going to reduce the retained earnings with same amount, $7,360. Make sense?
Yes.
Let's see number 7. What's happened number 7?
So we paid, so that means it's gonna be cash, an expense, right?
Which one? Number 7?
Number 7, yeah.
So let's think about it. We paid for the computers that we purchased. Did we pay what we purchased the computers? We paid those computers, right?
Yes.
But now did we pay when we purchased them?
No.
No. Now we paying.
Yeah.
So what's gonna go? Cash gonna, okay. Go for it.
Cash, and then because we paid, so now it will be expense, business expense.
Is it gonna be a business expense? What we paying for? Think about it.
Oh, we are actually paying for equipment.
For equipment, yes.
Yes.
So did we pay in the first place?
No.
No. Now we paying. So 27,600 cash going down. And what else going down? The money that we accounts payable. Make sense?
Yeah.
Minus 27,600. Let's see number 8. We incurred advertising expense on account. So we have the expense. Did we pay for that expense?
No.
No. So do we have to pay for that expense?
Yeah.
Yes. So let's add our accounts payable, $1,196 here. Accounts payable goes up, and our expenses goes with the same amount, right? No, that will be positive here. 1,196 accounts payable is going to go up, and here we're going to have the same amount, but with minus to increase our expenses. And we end balance, correct?
Yeah.
And the last thing that left is now we receive cash from the customer on the contract that we built. So this customer, so did he pay in the very beginning?
No.
No. Now 70,480. Now he paying only 11,400. So what we're gonna do? Get the cash first, right? Let's get that
Yes.
cash. 11,040. Give me the cash. 11,040. And what we're gonna do now with what else are we gonna do? In the first place, he didn't pay us. Now he pays us. So accounts receivable, but in accounts receivables, now we're gonna decrease the accounts receivables with 11,040, right? Why? Because he paid. Now the question is, once we do all those things, once we have all those things, what can we conclude out of everything that we did so far? First, how much is our total revenue? That was the first thing that we're gonna see, right? And we're gonna see that our total revenue is 2280, correct?
Yeah.
How much are our total expenses? 12,236. So if we have to prepare income statement, what will be that? We're going to have revenue of that much
Minus
expenses, which expenses will be negative that one. I'm putting this a negative because on the income statement, we cannot have a negative amount. Everything is positive. So on the income statement, everything is positive amount. So where is our net income? Are we generating net income?
Yes.
yes.
How much will be that? 2280 minus 12,230. We're generating $9,844. Now, the next thing that we have to prepare is to shareholders' equity. On the equity, what we're going to do? We're going to have the beginning balance. Which beginning balance? At the very beginning was 0. Then what we're going to do? We're going to add investment. Did this person invest money in the business?
Yeah.
Yes.
36.
He invested 36,800. Okay. Did the company generate net income?
Yes.
Yes, company generated net income 9,884. Did the company declare dividend?
No.
That will be 0 here. So here we're going to have add the add investment, add the net income less dividend, and what we're going to get? We're going to have ending balance of the equity. How much will be the ending balance? 0 plus investment plus net income of the company minus dividend. So now at this point, the equity which belonged to the shareholders is $46,644. Why? Because he invested 36,800 and company generated from him 9,844. The last thing that we have to do is the balance sheet. Now on the balance sheet, what we have to do? We have to simply come and see how much cash we have. And our cash is, so what we have? We have cash. And our cash is $13,800. Make sense?
Yeah.
Sorry about that. So next thing that we have to see is there any accounts receivables left?
Yes.
Yes. So let's put the accounts receivables here. And the accounts receivables are $6,440. Next thing, do we have equipment?
Yes.
Let's check that equipment. So how much is that equipment? $27,600. So we have equipment. Which is equal to $27,600. How much is our total assets? They should be 47,840, correct?
Yeah.
So now we have the assets. What do we need? We need now the liabilities. And owner's equity, right? So the liability. Do we have liability? Liability would be only accounts payable, right? Are you guys with me?
Yeah.
So we
Yeah.
have only accounts payable, which accounts payable is equal to 1,160, $1,196, and the equity on equity we have only owner's capital. And the owner's capital is equal to, actually our equity, we can easily say that here, our equity here, it's going to be equal to the equity that we calculated from the above, 46,644, And so the total liability and equity is equal to 47,840. The question is, are we in balance?
Yes.
Yes. Well, that was the first time that you did income statement, owner's equity statement, and balance sheet statement on the questions that you did today. Now you can say that you're accountants. Make sense?
Yeah. Do we have to submit that?
Which one? This one? No. That's
Yeah.
for you. That's for you
Okay,
for
okay.
practice. That's for you for practice. We're doing everything here for practice.
Okay, okay.
How was it?
Good.
Are you still scared of accounting?
Never been.
Never been. That's good. That's good. That's good. Well, I think that's a good finish for today's lecture. So what you can do is there are a few more questions that's sitting for you. Let me share my screen here with the. But those are more like on Blackboard. If you take a look above this transaction 5, there are a few more questions. Let me stop sharing my screen and share with the Blackboard on it. There's a question 1, question 1-2, and question 1-3. Take a look at those questions, and next time we can go over some of those questions. So we can start developing your confidence in accounting and to see that accounting is not that scary and it actually is very practical thing and it's going to help you to understand. The whole point here is with this exercise was you to understand from where the money coming from. Let's go back to here. From where the money coming from, where the money going in terms of the operations. This is only related to the operations. From where the money coming from and where the money going in terms of the balance sheet. Make sense?
Yes.
That's what we're chasing here. So we need to understand how much we're getting and how much we're spending on the operation. And from where, when we have the assets, from where the assets coming from and to whom the assets belong. So if I put this all shareholders equity here, if I balance it, if I put this, we are in balance. So what that means that my assets are equal to my liability plus my equity. And my equity is the original, the amount that the owners invested, plus the revenue minus the expenses, which revenue minus expenses is simply equal to the income. Make sense?
Yes.
So now we know exactly from where everything comes from and where the assets are. How much assets we have? We have 47,840. What kind of assets we have? We have cash. We have money to collect from the sales that we made, and we have equipment. To whom those assets belong to?
Company.
They belong to the company, but after we paying the accounts payable, right? Once we pay accounts payable, everything else belongs to the owner. Okay. No, we not. So I'm not taking attendance because attendance is for you, and I usually don't take attendance. But you're going to have the recording available. Where the recording will be available, let me show you where I'm going to post the recording. The recording will be posted after. So probably I'm going to open here a new section, and that section here was going to be recordings, and it's going to recording right here. Let's see, that will be probably a file folder, and the file folder is going to say recordings. And once I have to close now the Zoom, and once we close the Zoom, then that section will be available. The recordings will be inside. I'm going to start creating a new recordings, and the link for the recordings will be available for you. All right. Well, thank you for today.